Hey guys, in this video I'm going to teach you debits and credits in accounting. So you may have heard the word debit, of course you probably have a debit card, or the word credit, you may have a credit card, you may have heard the terminology credit to your account, but I'm going to teach you what debit and credit means in accounting if you were to take an accounting class or be an accountant. So all debit means in accounting is the left side of an account, and credit just means the right side of an account. So what I mean by that is in old school accounting, they use T accounts, which just looks like a T. That's all it is. And debit would be on the left side of this T, and any credits would be on the right side of the T. That's all it means. And these debits and credits represent increases and decreases to your accounts. But whether it's an increase or decrease depends on what type of account it is. So that's where it gets confusing. So if it's an asset, which all assets are resources of the business. Your checking accounts, your cash, your buildings, your vehicles, anything like that. Accounts receivable is considered an asset because it's something you're going to benefit from in the future as those customers pay you. So assets would be, just think of that as resources of your business. So the debit side would be adding to the account. So it's going to represent any increases to the account. And the credit side would represent any decreases from that account. So if you buy a building, you're going to add to your building account by doing a debit. If you sell a building, you're going to subtract from the building account with a credit. If you make a deposit, you are debiting or adding to your cash or probably your checking account. In accounting, I say cash a lot, but I mean checking account. It's just an accounting thing. In textbooks, they call it cash, but in real life, most people have checking accounts and savings accounts. But anytime you're adding to those types of accounts, it would be a debit. Okay, and then this next one's going to be confusing, but hopefully I can explain it. Okay, if you have any expenses to run your business, so expenses are just day-to-day costs of running your business, rent, phone, utilities, office supplies, things like that, things you need to buy or pay for to operate your business. So you're going to add to those with debits and subtract from those with credits. You're probably not going to subtract from an expense very often unless you're making a correction or doing some type of return. So if you go to Walmart and you buy some office supplies, you're adding to your office supplies expense account. So it would actually be a debit. Even though you're spending money, it's kind of confusing because you're adding to something. But the idea is you're going to keep adding to that expense. Every time you buy office supplies, you're going to add to that expense account. And then at the end of the year, you're going to want to see a total of all the money you've spent on office supplies for the year so you can put that on your tax form. So as you're spending money on expenses, you're adding to that individual expense account. Same thing for rent. Every month, if you pay rent to have an office space, you're adding to your rent expense account, adding to your expenses so you can get a total at year end to see how much money you made or how much money you subtracted from your business because it's something you pay. But in other words, the idea at this point is get totals, and then those totals will be put on reports to see your profit and loss. But at this point, you're just entering them. So when you enter them, expenses, you're adding to the expenses. Okay? And then there's some accounts that have opposite rules. So debts. In accounting, we call them liabilities. So if you have a note payable account or accounts payable or a credit card account, any money you owe is going to work in the opposite direction. So the debit side would be subtracting from your debt. So as you're making payments towards a debt, you would be debiting that debt account in your books. And then the credit side would be when you add to your debt. So when you borrow money, you're going to make a credit entry to that account, to that payable account or liability account. So again, it's kind of like expenses. It kind of works in the opposite way you would think. But again, this is just to make entries in your system. And then at the end of the year, these totals are going to be put on reports so you can file your taxes. Okay? Okay, and then another type of account with this rule would be equity. So equity represents the owner's investment in a business. So as the owner's putting money in, it's going to be credits. As the owner's taking money out, it would be debits to the equity accounts. Okay? Okay, and then the last category would be revenues. This is money earned from selling products and services. So as you add to your revenue account, as you sell, say you sell a product today, you are crediting the revenue account. And you probably debit the cash account because you're adding to cash at the same time. But your revenue would be a credit. So anytime you add to revenue, you'd be a credit. You wouldn't really debit or subtract from revenue unless you were, say, issuing a refund to a customer or something like that. But most of the time, you're going to be doing credits. Okay? So these are the basic rules of debits and credits. And then in accounting, we have something called a double entry system. And what that means is if you're doing a debit to something, you're going to have to do a credit to something else. There's always going to be a debit and credit in each transaction because in the end, your total debits need to equal your total credits. So just keep that in mind. You're either adding or subtracting to something as a debit, and you're adding and subtracting to something as a credit every single time something happens related to money in your business. So let me just go through some examples to help you kind of understand these concepts a little bit better. And I'm going to use the old school T accounts, but if you were using this in an accounting system like a software, you're not going to see T accounts. And that is something I want to point out. When you're using a software to do your accounting, it's doing these debits and credits behind the scenes. You just don't see it unless you're actually doing a journal entry and debiting and crediting something. Most of the time, if you're writing a check or you're posting a deposit, it's not going to tell you that this is a debit or this is a credit. It's just going to make the entries and it's going to be doing it without you seeing it. Okay, so let's do a couple of examples just to kind of give you an idea. So let's say you're starting a business and you're going to borrow $5,000 to get it started. So you've got two things going on here. You've got a deposit of money into probably your checking account. So that would be one account that you would be tracking. And then you'd have a debt of $5,000, which I'm just going to call it note payable. So you've got those two things going on. So on the debit side of your cash or checking account, you're adding $5,000 to that. Okay? Because you just gained $5,000 in your checking account. It went from 0 to 5,000. So that would go on the debit side, okay, to add to it. If you're going to pay something, it would be a credit, okay? And then the note payable account, this is a debt, so you show increases to debt with a credit. So it would go on this side, the credit side. So you've got one debit, one credit. So anytime you add to debt, the rule is you're gonna do a credit. Okay, let's do another example. Let's say you got this deposit, now you've got money in the bank, and you have to pay for office rent. Let's say you're renting an office, a little cubicle somewhere for $600 a month. So now we need to add a rent expense account. So for expenses, the rule is if you're adding to them, it's a debit. If you're subtracting from them, it's a credit. So whenever you pay an expense, you're adding to your total rent expense balance. So we would add, what did I say, 600? 600? I don't know if I said 600, but we're gonna go with it. So you would add 600 to the debit side of rent expense, and it would go on the credit side of your checking account or cash account, because you're subtracting, you're paying something, it's taking away from the money. Okay? So see how I did a debit and a credit to two different accounts? All right, let's see if we can do another expense example. Now let's say you have to go to the store and buy some office supplies. Let's say you go to the store and you spend $200 on office supplies. You're adding to your office supplies expense account with a debit, and that's again going to take away from your checking account or your cash by $200, so that would be a credit here. So I have more of these examples, which I'll make some more videos with additional examples, but for now, hopefully this will kind of give you an idea of what debits and credits are. And hopefully this helps you understand it a little bit better. And if you have any questions, feel free to comment below and I will try to answer those questions. Thank you.